Hey there, everyone. Happy Thursday. Welcome to the Final Bar. I'm Dave Keller, the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the power of the StockCharts platform. StockCharts was launched 25 or so years ago to empower investors and individual traders to better understand the markets using the language of technical analysis. I will say there are some times when charts are helpful, but not maybe the most necessary thing, when it's sort of a big picture move and everything's kind of working. This is not one of those times. This is one of those times I feel like you really need to have a disciplined process of charts. I would say with a great amount of bias, you always need to be looking at charts as much as possible, but that's my background as a technical analyst. I would say this is one of those times when there's a lot of fluctuation, there's elevated uncertainty, elevated volatility. A disciplined process, a regular routine of reviewing some of the charts that we're sharing on the show is so vital to really improve what I call your market awareness, your understanding of what's happening, what's working, what's not, what's going up, what's going down, where the opportunities might be. That's not something you can do by just spending a little time on a chart at a random moment when you have it. You really have to set some time aside. That's why we do a morning coffee routine, and that's hopefully how the show can fit into your own daily processes by trying to make sense of what we've learned on a particular trading day and think about some of those levels and patterns to look at in the day to come. We have a great guest today, Bob Lang of Explosive Options, a true trend follower, sharing some of his insights on some of the leading names that have had good runs. With that in mind, let's look at the markets through our market recap and see how the charts actually played out today on a slight update here for the major averages. By the way, we asked a poll recently, which FANG stock would you be most comfortable shorting here? We gave you the 5 choices: Meta, Apple, Amazon, Netflix, and Alphabet. What's really funny, by the way, today's guest, Bob Lang, actually originated the term FANG. He first shared it on the air on a financial media network, and it took off from there. So with that inspiration, we ask you which one would you be most comfortable shorting, right? Which one would you be most comfortable playing on the downside? Apple, the most responses, around 38%, followed by Meta with 27%, Netflix at 20%, and then Amazon and Alphabet single digits. So we are most comfortable shorting Apple, and I would probably wholeheartedly agree with that assessment. Out of those 5 charts, right, you have the Metas that are sort of clearly breaking out. You have sort of the Alphabets that are kind of choppy, and Netflix and others doing a little bit better, but Apple is an outlier in that it really never broke out, right? Most of the Magnificent Seven, as we probably now think of them, have broken to new highs, and now it's all about how extended they are, like a Meta, right? It's gapped higher. How much further do you see that going? Apple literally never broke out. As a matter of fact, I would argue I'd label this as a failed cup and handle breakout, right? A cup and handle pattern is when you have a big run, you have this big rounded pattern like this, you have a similar resistance level called the rim of the cup. You then have this shallower pullback called the handle. We break above that rim, so we break above 198.200, and this is a screaming buy type of pattern, and it never happened. You never had that breakout. Now, we're actually testing the low of that handle, and today we briefly traded below the 200-day moving average. Now, in the general, right, a leading stock pulling back to an ascending 200-day moving average, that's often where you would find a bounce higher, like we saw in October, like we saw in a couple times in January, and then here, potentially this week as we close back above there. But that 200-day fails, 180 fails to hold as support. I think this is a dangerous chart, certainly with potential, if not a probable move back to the October lows around 165. So Apple really with a question mark, I think, compared to those others. I think we're right at that point where I would agree that's probably the one that I would pick. So thumbs up, Final Bar Nation, on which of those 5. Looking at the rest of the markets today for our market recap, S&P up about 0.6%. It's interesting, morning we sort of traded higher, pulled back, and the S&P actually briefly touched the 5,000 level again around 11:15 Eastern time, and then really took off, touched 530 and settled in just below there. So we'll call it 50, well, I'll call it 50-30 with the rounding up a little bit, up 0.6%. The NASDAQ composite up about 0.3%, the Dow up 0.9%. So this is one of those value over growth kind of days. And if you look to the right at some of the sectors at the top of our sector list, it's not the FANG sectors, right? It's not the growthy stuff. It's things like energy, defensive stuff like real estate. Those are the sectors actually thriving today. And when those sectors are doing well, mid caps and especially small caps tend to do better, right? And I think that's more than anything, is probably just a sector phenomenon, right? The NASDAQ is overweight on technology and communications and consumer names. The small cap index is much more weighted to other sectors like financials and energy and industrials and healthcare and other types of sectors, a little more broadly distributed, particularly around the value sector. So when value is working, you're going to see small caps do better. The S&P 600 small cap index up about 2.4% today. The VIX pulling back a little bit, staying right above 14, but right at that 14 level. And we talked yesterday, I want to say, about those levels on the VIX and what's sort of an initial warning sign versus something more significant. Talk about 20 as being that sort of general back of the envelope level, above or below, as a good measure of a high volatility versus low volatility environment. So here with a VIX in sort of the mid-teens, kind of a low volatility environment, things are pretty good until we break out. That's why I think the VIX is an important chart still to watch as you think about potential downside in February into March, which seasonally tends to be a pretty weak part of an election year. Interest rates coming off a bit, so you have the 10-year yield down just below 4.25, the 30-year yield around 4.40, and the 5-year yield around 4.22. Short end of the curve, of course, is still pretty elevated. This is the stuff that the Fed controls, is sort of that short end of the curve. The long end of the curve is more driven by free market forces and optimism or pessimism about future economic growth or lack of economic growth. So overall, that inverted yield curve tends to be a negative sign for the markets, tends to suggest more a higher risk of recession. The dollar index down about 0.4% from yesterday's close. Commodities, a lot of green here actually. Gold up about 2/3%. That is, silver up 2.5%, copper up 1.5%. Oil prices doing well. Natural gas was slightly lower, but a lot of the commodity space was higher. And as I mentioned, energy actually ended up being the top market for of the 11 S&P sectors. Bitcoin slightly lower, still above 50,000. We talked about kind of S&P 5,000, Bitcoin 50K. Those are sort of those really important big round numbers. And in this sort of environment, I like to simplify. I usually like to simplify in all environments, but especially now when we're right around those big round numbers, right? We stay above 50,000. Bitcoin's pretty constructive, and as long as we go higher, we start to bump up that level, that line in the sand. I think with the S&P 5,000 is a decent sort of short-term level. S&P above 5,000 is a pretty strong chart. We get below there, then things are starting to get a little uglier. Mixed results overall from cryptocurrencies, but Bitcoin slightly lower, Ethereum slightly higher, around 28, 23. Looking at the 11 S&P sectors, you will see energy, real estate, both having really strong days. The XLE, which is the energy sector, up 2.8%. Real estate, number two, up 2.4%. Materials, up 1.9%. Only one sector was down, and it's technology, down 0.2%. Consumer staples and healthcare are your next two from the bottom of the list. Looking in terms of the Magnificent Seven stocks, sort of those major growthy names and what they're doing here, you'll see Tesla at the top of the list, having an incredibly strong day. Now, Tesla, out of this group of 8 names, the laggard by any definition, by any stretch, any list I would make, Tesla would definitely be at the bottom, and then I'd kind of build it up from there. But Tesla having a nice day, bouncing off of support, up over 6% today. We'll look at that chart in a moment if we have. Netflix and Meta both up over 2%. Alphabet down over 2%. NVIDIA down 1.7%. Let's go to a daily chart of the S&P 500, check in on where things are at. No surprises in that, given the market slightly higher, we're remaining above trendline support. And again, trend lines for me are a good visual representation of the pace of a move. I draw trend lines a lot on the charts that I use in my own process, because for me, that's the conversation I have with the market. Instead of writing a bunch of notes on a piece of paper or writing a bunch of annotations, I like the charts kind of clean, but I draw lines, and I think of it as sort of the conversation. It's a workbook that I am using, and the daily chart of the S&P is the workbook that I use the most. Every morning I'm looking at this chart first thing and just sort of thinking about what the trend is. And what I've been reflecting on here in recent weeks, as long as we remain above trendline support, this is a pretty strong market. And that's why I would say when we gapped lower on Tuesday, right, certainly an initial downside gap, which was significant, I wouldn't be surprised if there's more deterioration. I can't imagine that's it after the run that we've had. And given the seasonal weakness, I think February into March probably is a lot weaker than many might expect. But yesterday and now today's session, Wednesday and Thursday, both bouncing very nicely off of that trend line and sort of a reaction to that initial drop. So we talked on Tuesday's show as the market was trading lower, kind of closing right at that trend line. One of two things happens, right? You probably bounce the next day, which is pretty common, and then it's, do you see additional buyers coming in and bidding stocks back up, or was that the initial salvo before we break down? And sort of watching that low from Tuesday's session, I think is just a short-term, level to pay attention to. Could be pretty meaningful. And I would say this trend line overall is still strong. The momentum is encouraging, right? The momentum is actually quite strong with the RSI, above 50, but not over 70. That's kind of where you want it to be in a nice, sustainable up market. So we have stronger stocks, we have lower volatility, and for now that tells us to remain tactically bullish for sure. We talked a lot on yesterday's show about some of the breadth indicators and through the course of the last couple of weeks. So I want to jump into just a lot of names here and just think about some of the patterns that we're observing looking at individual stocks. There's quite a bit of earnings at work here, a lot of names on the move. So through the remainder of our market recap, I'm just going to go through some of the individual stocks. And I think with my guest today, Bob Lang, we'll dig into some of the macro themes as well on interest rates and elsewhere. Super Microcomputer remains the top-ranked stock in our Scooter large cap ranking. And if you look, what's so fascinating is we're now over $1,000 a share. This stock actually broke above $350 not too long ago. This is 4 weeks ago. This is a stock about a third of its current value, and it's breaking above resistance. And this, I think, is a great reminder that the beginning of the move can be the beginning of a breakout is rarely too late, right? Leading big time winners. I'm talking multiple winners over, things that are 200, 300 times their value going forward are ones that initially had that breakout. They're at the top of the page, but I was told never confuse the bottom of the page with support, never confuse the top of the page with resistance. So when stocks break out, that's usually a really good area of the market to focus on. That's why I scan for stocks making new 3-month highs. This is where SMCI first came up on my scans, and overall, it's just continued to push to the upside. It's concerning how strong it's got. Now we're at a big round number of 1,000. That is when, if you think about like when Alphabet, I'm thinking like Oracle. I'm probably butchering some of these names because I'm trying to think a couple of years ago when some of these stocks hit 1,000. I know Apple, same thing. It's like when you hit those big round numbers, usually something important happens. And so, this is a day where SMCI has finally gotten there. We'll see if there's enough optimism to continue to push us higher. By the way, the RSI is almost at 100, which is almost impossible, and if not literally impossible, and it's certainly quite rare, because what that means is you literally have no down days over an extended period of time, and the exponential smoothing would have to work all that out. It would be virtually impossible for that to happen. This is about as high of a rating in terms of the momentum you're ever going to see. This is an overbought and then some, with multiple exclamation points after that. Apple is a concerning one. This is one of those names that's sort of in the middle of the range, and we talked about this with our poll question today. I think holding the 200-day and holding that recent swing low around 180, as I mentioned, I think that's something to watch. But I didn't get to show the chart of Tesla. Now Tesla's actually bouncing very nicely off of a support level. And what's interesting about the chart of Tesla, again, I think there's when you have a stock that has had a run, and then you're sort of within those extremes. This is literally why Fibonacci retracements were created, right? Because you basically have a big move, and then you look for where the market or where the price might retrace between those extremes. So I'm basically taking that initial run from the January 23 low, the July 23 high. Which levels do the Fibonacci retracements tell you important? First one's 224, and that's pretty much right where we gap to there. Here's 200, which is pretty much where this low in October was. And now we're to 177, which is literally where the low was in February. So if you're looking for future textbooks on technical analysis, I would say probably Tesla over the last 12 months, probably a pretty decent example of after an initial run higher when we sell off. These are really key levels to pay attention to. This is why I often draw them on my charts and then refer back to them many, many times, because the general idea is you expect support there. You expect some buyers to come in because that's enough of a retracement that usually there's a mean reversion move off of those lows. We've had tradable bounces off of each of those Fibonacci levels. Now we're having a bounce off of the last one. I wouldn't be surprised if there's maybe a further upside to test some of those declining moving averages. Maybe the next step for something like Tesla. But wanted to point out that good Fibonacci example we're observing here. AirbNB, what a strong breakout here when you're looking at the travel and tourism trade at times, I'm thinking of charts like Hyatt and others, all sort of breaking out here. Hyatt's one because it's breaking out of this consolidation that it's been in for the last couple weeks or so. You can see AirbNB with an inverted head and shoulders continuation pattern, which is when you have a run higher and then you have this head and shoulders upside down sort of pattern. The low surrounded by higher lows. We have a clearly defined neckline. We finally broke above that now this week. And I think today's move with a 6+% rally on AirbNB, pretty constructive breakout. Now, that pattern actually measures much higher. That measures up into like 195, 200-ish would be my guess, just visually based on the height of that pattern and projecting it off of that breakout. But overall, think about how extended some of the growthy stuff is. This is actually earlier on, just starting to break out. So looking for opportunities of early stage breakouts can be pretty beneficial. Barrick Gold, we've got a number of names sort of reporting earnings, and I'll go quickly through some of the names. Gold was yesterday. This is Barrick Gold. The ticker is GOLD, so a lot of people actually get confused about this. $ GOLD is the gold future on our platform. GOLD is actually a stock. That's Barrick Gold, which is a gold miner. And what's interesting about Barrick, it's actually pushing higher today, almost 4% upside. But what's interesting is it's bouncing off of support. So this is a stock that actually tested the October low. You can see we're oversold here, similar to where we were at the October low. And I'm not a value-oriented investor, generally speaking. For longer-term stuff, I am. But for something like individual stocks, I'm more looking for breakouts than breakdowns for opportunities. But if I was looking for beaten down names with the potential to reverse to the upside, something like a Barrick Gold would probably be pretty compelling in the fact that we've gone oversold and now just bounced off of that oversold region. We're doing that right at a previously established level of support. Gold stocks have been struggling here the first 6 weeks of the year, that is, but potentially we're finding support here. So I think watching that 14 level and seeing if we're able to mount a further advance off of that support could be really helpful. A lot of energy names on the list today of big gainers in the S&P. Occidental, OXY, is one of those names bouncing off of support. What's interesting here is there's established support around $56. Those are the lows from February, earlier in the month, from last month, from the month before, also back here from summer of last year, all around $56 a share. So we're bouncing off that level. So, generally speaking, being a buy around 56 and just betting on an advance further to the upside, pretty compelling to be sure. Just to finish off, maybe one more name or two, I would say Applied Materials. In terms of earnings to watch, you have John Deere just reported before the open. After the close today, we have Applied Materials, AMAT. This is one of those leading growth names breaking out of a base, continuing to trend higher above two upward sloping moving averages. There have been a number of names here in recent weeks that have looked really, really good until earnings. Then they have this big gap down and everything starts to change. The other one I'm watching besides DraftKings would be something like Coinbase. Now, Coinbase obviously doing well here recently, driven off of the optimism around Bitcoin and cryptocurrencies. This is obviously a core to their business model, but bouncing off of support around 115. I'm eyeing that resistance level around 185 to 190. Does a nice earnings beat push us above that previous level of resistance. That is our market recap for today. As I mentioned, we have a really good guest today, Bob Lang of Explosive Options. Before we bring on Bob, just a couple quick announcements to continue on. First off, we welcome your questions. We're going to do an all mailbag show on Friday. As a reminder, Monday, no live show because of President's Day holiday. But we would love to feature your question in our next mailbag show. Email is always best, thefinalbar@stockcharts.com. On Twitter or X, tag us in a comment @FinalBarSCTV. And on our YouTube channel, just drop a comment below the video that you're watching. And again, as always, include a link to the chart that you're looking at using the permalink, little link button that you see on our charting platform. It's a great way that I can see the chart that you're asking about. We have a survey going. We are in the process of evolving Stock Charts TV. You may see some shows go away. You may see some new shows pop up. And we are really keen on allowing you to help us sort of set the stage or chart a course, I guess, pun intended, for Stock Charts TV. So please, if you wouldn't mind, scan the QR code that you see on your screen. Take a few moments to answer some questions for us. Help us think about where we can focus some of our content. What's going to help you answer the questions you are trying to ask as an investor? So again, make sure you scan that QR code. Take a few moments to answer that survey. We would super appreciate your feedback right about now. Finally, I will be doing a free webinar next week for market misbehavior called Momentum Matters, how the pros use RSI. On all those charts that I just showed, the RSI indicator was toward the bottom of every one of those, and I'm always looking at that as a great measure of price momentum. We'll talk about this RSI indicator, how it's constructed, how to use it in short-term versus long-term applications, and look at a ton of examples together. You can sign up for that free event coming up next Tuesday the 20th by going to marketmisbehavior.com/RSI. I want to welcome on today's guest, Bob Lang. Bob's the president of Explosive Options, coming to us from outside of Boston, Massachusetts. Bob, happy winter, happy new year. Good to see you back here. How are you?
I'm doing great, Dave. Thank you very much for having me. It's always a lot of fun to spend a little bit of time with you and the audience as well too. It's been a pretty crazy first 6 weeks of 2024, and it's always great to touch base and come back with you and see how things are going.
There's a lot going on. I'd love to touch on a number of things, time permitting here. We're starting with your chart of small caps, the IWM. And a lot of discussion has been made in recent months over time about small caps participating, whether or not they're engaging here. What do you see on the chart of the IWM? What's sort of your sense of that area of the markets here?
Well, it's interesting, Dave, that the small cap index, Russell 2000, is literally. You might consider it in a bear market if some of the logic holds for 20% lower than all-time highs or recent highs. So it is about roughly 20% below the all-time highs. I think it's a stretch for calling it a bear market, of course, Dave. But when you have the other indices like the NASDAQ and the S&P 500 and the Dow Industrials all hitting or sitting at new all-time highs, it makes you scratch your head and wonder, what is wrong with these small cap stocks and why can't they get moving and get up high enough, to at least get to a 52-week high, if not an all-time high. And I think the answer lies in interest rates and financing costs and so forth. And Dave, we've seen over the years that the dynamic between the Russell 2000 or the small cap stocks and the 10-year, which is what you're showing right there on the 10-year yield, not the bond, but the yield, they're really conjoined. And what generally happens is when interest rates are rising, we see weakness in the small caps. And the small caps have a huge weighting, at least for the rest of the market, when you're not talking about cap-weighted indices like the NASDAQ and the S&P 500. And on an unweighted basis, the Russell 2000, just because of its enormous size, carries the greatest amount of weight and can move markets around up or down. So when you're getting that influence of the Russell of the 10-year yield climbing up there, and which we know is it's like kryptonite for the Russell 2000, we see that index tends to bring down the rest of the indices. Now, of course, more recently we saw some big movements up in the yield when the CPI came out, Dave, on Tuesday, and that tended to bring down the Russell 2000, and it brought down the rest of the markets. S&P 500 at one point was down 2%, over 100 handles at one point. So it was interesting.
What do you think about rates? I mean, obviously the inflation data came out, the idea of higher for longer is now what we're digesting. Is that how you're thinking of interest rates, just sort of bracing for elevated rates over time, or what's your take on what investors should expect going forward here?
Well, I really think that the Fed has been very consistent in their message, and if you looked at the projections from the materials that they put out in December, all they really implied was that there would be they're kind of on the fence for rate cuts in the beginning of the year, but they're looking at about 2.5 rate cuts in 2024. Now, the markets got way ahead of that. And in fact, I think at one point in time, Dave, a couple months ago, they were pricing in 6 rate cuts in 2024. Didn't quite really see how that could reconcile with what the Fed was looking for. So when we see these readings like we saw on Tuesday with a hot CPI, and of course, Friday, we're going to get a PPI number, producer price index number, and we'll see how the market reacts and responds to that. When you see these hot numbers come in, what's going to have to happen is the market has to adjust to where the Fed is at in their analysis. So I think we went from about 5 rate cuts expectations on Monday, or last Friday or to Monday, to about 4 on Tuesday. That still has to come in a little bit more. And when we get those adjustments, Dave, we see the markets react in kind, and it's not kind to the bulls. Let's put it that way.
Your third chart is looking at volatility as earlier this week on Monday into Tuesday, the VIX spiked up almost to 18 very, very quickly. Now we've settled back down, sort of back to the low teens. What do you see in volatility? Does that make you more or less optimistic for going forward here?
Well, as it relates to volatility, Dave, I'm a trend follower. I like to follow trends like you. And as you can see from the chart you're showing here, the trend has been somewhat sideways to slightly up on volatility. So I would say that moonshot that happened on Tuesday is somewhat of an anomaly, but it continues to happen day after day over the next several weeks. You have to take notice, and all of a sudden these moving averages are going to start moving up. You show the 50-day and the 200-day moving average on the VIX, and you can see that those are either going flat or bending down, and that is bearish for volatility. And whatever is bearish for volatility is bullish for markets. So I think if that trend continues on like that, it's still easier sailing for the bulls.
We're sort of in this situation now, the major benchmarks sort of in pretty decent uptrends. In our market recap, we talked about names like DraftKings, earnings names, but just in these incredibly strong runs. I think for a lot of investors, hopefully that have been owning some of these leading names, you're getting nervous on a day like Tuesday. All of a sudden it's a wake-up call of they might be able to go down sometimes. Are you in a mindset of taking profits on these kind of names? Is it more stay with the trend? How do you approach a name that feels very extended at this point?
It's a great question. I tend to like. I'm a trend follower. I'm an options player, and I like momentum. I like velocity. I like speed. I like agility. I like some of these stocks that really demonstrate good, strong performance that can do well even when the market is not doing particularly well. So I tend to I'm taking profits as we go along all the time, Dave. I did that today with DoorDash. I did that today with DraftKings, which those two stocks have earnings here out after the close. But these stocks have been on such a big run that you'd be foolish not to take some money off the table and at least take some of your risk off. So if you do have a play continuing on, you're able to, if it doesn't go in your favor, then you still have a chance to say, okay, well, at least I took some money off the table. I'm not going to get blasted. But I think that really the key here is that being able to put yourself in a position where you can take some of that risk off the table and ride that momentum. Listen, you know what? Nobody rings a bell at the top and nor at the bottom, right? And you and I are very similar in terms of our approach for looking at stocks and charts. It's not. I've always said that tops and bottoms are a loser's game, and so I know you make your money, you make your bread in the middle of the tops and the bottoms. That's where the trends are at, and that's where the momentum is at, and that's where you can make the most money. Not necessarily buying at the bottom or selling at the top or what have you. So in the middle of those zones is where the money is made, the good money is made. So I think that by and large, I think taking some money off the table here and there, but being able to ride that momentum as long as you can is really the way to go.
That's well said. What do you think with names like DoorDash and DraftKings and others, and not just those particular names, but do you have a general way that you approach earnings? Because earnings a lot of times can be that binary outcome, right? We spike higher, we spike lower. Do you sort of hold names through earnings and just think of it as sort of the natural progression, or do you have a general way of thinking about those earnings dates and the potential risks on both sides?
Well, yeah, there is a lot of there is some risk on both sides of the market. But for every Amazon that goes up like it did, there are probably 5 Googles that got collapsed, that got hammered. So it's not a real high percentage play. But if you catch one, we caught one with Meta a few weeks ago, and that was a beautiful play. You just need really one of those, and then there's another one. Dave? Have you heard of this Super Micro?
Yeah, it's come up here and there. Yeah, I think so. Almost just over $1,000 a share today, for the record.
It hit $1,000 today, and Nvidia is another one that they have earnings out next week. So a lot of people are excited and enthusiastic about that. So one of my approaches, Dave, for playing Nvidia, for instance, I was getting into this name about 3 weeks ago, 2 or 3 weeks ago. Now they have earnings next Thursday after the close, and I know there's going to be a lot of excitement, a lot of enthusiasm from people getting into this name. And I know from an options standpoint, the implied volatility is through the roof. So the expectations for a $730 stock are enormous because the market makers are not going to lose money. They're going to make sure that you pay for it if you really think that stock is going to move up a lot. So you're going to see a lot of buyers, a lot of demand for Nvidia next week, Tuesday, Wednesday, and Thursday into the print. So I think my best strategy here has been playing it up until then. So I was starting to play the stock when it was in the high 680s or 650s, 650s actually to 680, and now it's up to 730. And I've really had a chance to ride out some of these trades and ride out some of this momentum before the earnings come out. Now, what could the earnings do? I mean, could it launch the stock $120? Sure. Could it drop at 200? Absolutely. It'd still be in an uptrend. So I preferred to be out of a name like that. But other names, like a DraftKings or something like that, show some great strength, great momentum. The charts are fantastic, and I want to be in those names into the print.
You're a great treatise right there on trend following and the benefits of buying breakouts that have the potential to extend there, Bob. We'll have to leave it there. Great to see you. Happy New Year. Thanks for coming back on the show. Stay warm there in the Boston winter. We'll talk to you again soon.
Great to be with you, Dave. Thank you for having me.
That's Bob Lang. Bob's the president of Explosive Options. Those are like little mini master classes in the benefits of trend following. And it's so funny when you look at a super microcomputer or a DraftKings or NVIDIA or a Meta or any of these names. I remember early on in my career, I was really hesitant to buy new highs because it felt like you were way late. And just in the last 3 months, we've seen how many examples of new highs that turn into further new highs and further new highs, right? The beginning of those moves and through the bulk of the moves, there's a lot to be made there. Just make sure you have a good money management strategy on the way up and be prepared for the potential downside risk there. Great take, as always, from Bob Lang at Explosive Options. We got to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. So here we're looking at the 10-year Treasury yield, and again, higher yields tend to have a lot of different ripple effects, and I think a lot of times equity investors, certainly seems more recently, we've warmed up to the idea that you really need to understand the fixed income markets. When I was getting started in the industry, and certainly my time at Fidelity, I spent a lot of time talking with the fixed income guys with the high yield trading desk because I always found they were laser focused on risk. We talked with our guest yesterday, Ms. Schneider, about high yield and why that's an important measure to look for in terms of risk awareness or risk appetite. I think the 10-year yield going higher is one of those pain trades here, right? Higher yields tend to make it a much less optimal setup for certain areas of the market, particularly growth stocks. And having said that, what's interesting is as yields have stabilized and started to turn higher, it's still value underperforming growth quite a bit. And I think the fact that growth has been outperforming value during periods of rising interest rates really tells you the dominance of that AI trade, which continues to, I think, dwarf all the other factors in terms of what's driving individual equities and particular groups. And also the fact that in a lot of ways, this is more of a defensive position, right, to go into some of the mega cap growth names and ride out periods of uncertainty. With that in mind, though, higher for longer seems to be the key. I thought Bob Lang's discussion about rates was pretty interesting earlier. So keep an eye on $TNX, what sort of movements that might help us identify. Chart number 2 is GDX, the gold miner ETF. We talked in our market recap about Barrick Gold, GOLD. Here we're talking about the gold miners ETF, GDX, and this is sort of a Fibonacci soup of lines that I have. A lot going on here. I apologize for the busyness of this chart, but a lot of times, as I mentioned earlier, I think of charts, my own charts, as sort of a conversation you have with the markets and thinking about key levels. And I want to point out that a lot of the movements that you've seen in gold couldn't be identified or can be lined up very well with Fibonacci levels. For example, the high in May of last year was sort of the high for the year, down to the low in October, which ended up being the low of the year. That first rally hit a 38.2% level. The next move higher stalled out right at the 61.8% level. we're kind of bouncing back down and nearing that $25 point as well. Now, if we go even further back, go to the September 22 low and go to the April 2023 high, you can see 61.8% of the way down, lines up pretty well with the September, October low and November lows of last year, and also where we're at right about now. So a lot of times what I like to do on stock charts is apply some of those Fibonacci charts on longer term, multi-year charts, and then go back to those and regularly see how the price is trading around some of those key levels. I wouldn't be surprised if we get a little more of a bounce off of this level, and that we are lining up with a lot of previous levels of support on gold miners, the GDX. Finally, AirbNB, we highlighted in our market recap, with so many names overextended, and I would agree. I think Bob Lang had some great guidance there in terms of sticking with winners, right? And as a trend follower, that is the essence, is just letting your winners run and continuing to follow trends as they go higher. And there's so many examples of that. But there are also stocks sort of earlier on in their breakout. I think AirbNB today is completing a rotation out of an inverted head and shoulders continuation pattern. In purple, I have the neckline identified, which are the interim highs between the head and the two shoulders. The measurement, sort of the minimum upside objective, is determined by taking the height of that pattern and projecting that from the breakout level. That measures up into the upper 190s, almost to $200 a share. That's about 40 points above current levels. So we'll see what happens through the remainder of this week. But buying breakouts earlier on, after they're just emerging from those bases, can be a very profitable approach to stock picking. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the Final Bar. A special thank you to Bob Lang of Explosive Options, joining us from Boston. We'll be off on Monday for President's Day. Tomorrow we'll have an all mailbag episode, and hope you can join us then. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night. Ooh, and happy birthday, Henry.